Hello, welcome, and welcome back. As you can see, we're in a festive mood at Consumer Action. Thank you for joining us today for our convening webinar as we celebrate 51 years in the business. My name is Linda Williams. I am a Community Outreach and Training Manager with Consumer Action. And joining me today is my colleague, Nelson Santiago. He's a Community Outreach and Training Manager with Consumer Action. And on behalf of the entire staff at Consumer Action, welcome. Now, as part of this special event, we're going to examine how to overcome barriers to housing and access to credit, which are chief contributors to housing insecurities. We're also going to explore how lawmakers, community leaders, public, private, and community-based organizations like yourself can all collaborate to create a solution to this crisis. But before we get into the webinar, please allow me to take a minute to celebrate Consumer Action. From its idealistic 1971 roots in a small room donated by a San Francisco church with a few volunteers to its current status as a national champion of consumers, Consumer Action has stood strong and has never wavered from its commitment to consumers. But you know what they say, an organization is only as good as its people, and there is nothing more powerful than people who embody the mission of an organization. Nelson and I would like to take a moment to pay homage to the people who came before us, those volunteers in that small room in that church basement who built the house that is Consumer Action. Thank you. We would also like to acknowledge the people who have fought alongside of us in the trenches to empower all consumers, especially underrepresented consumers nationwide, how to assert their rights in the marketplace. Thank you, comrades. And oh my God, to our audience, all great teams have supporters, cheerleaders, and you have been ours. You have supported, inspired, and educated us. You have pushed us to do more and pushed us to do better. There will not be a Consumer Action without you. Thank you. Now, every organization needs sponsors, especially today. So today I need to recognize and thank our sponsors for their unwavering support. We couldn't do it without them. A very special thanks to our presenting sponsor, Walmart. We are extremely grateful for your continued unwavering support. Walmart's support supports our mission, and that support is in the way of financial contributions to us at the highest level year after year. Thank you, Walmart. Thank you for believing in us, and a special shout out to Mark. We would also like to thank our leadership sponsor, which is Capital One, our guardian sponsors, which are Amazon, Bank of America, JC Morgan Chase and Company, and Wells Fargo. Also, since this is a fundraising, if you would like to contribute to Consumer Action, you can go online and contribute $25, $20 by credit card or PayPal. Just go to www.consumer-action/giving, or you can mail a check to us to Consumer Action, 57 Post Street, San Francisco, California. If you can't write a check, you can still support us. You can support us by subscribing to our YouTube channel. It's free and would help us continue to bring you these awesome webinars. Our goal today by the end of the webinar is to sign up at least 200 new subscribers. So Nelson will provide you with the information on how to subscribe in the chat box. So start subscribing. Now, let me go over a few housekeeping items and give you the roadmap for where we are going today. This is a 90-minute webinar and it is being recorded. You will receive a link to the recording and the PowerPoint slides used by our guest speakers today and handouts before tomorrow afternoon. Now, if you are AFCPE professional, you will also receive the code to claim your credits for attending today, no later than tomorrow afternoon as well. If you have any questions during the presentation, please type them in the go-to question box at the conclusion of all presentations. Outreach Trainer Nelson Santiago, he's going to lead a question and answer segment. This is where we get to hear from you, so please send Nelson a ton of questions. At the end of the webinar, you will receive an evaluation of today's event. So please complete the survey and return it to us as soon as possible. Now, this evaluation is going to look a little different from the ones you've received from us in the past. mainly because we need to answer a few demographic questions. Don't panic. We just need to collect this information so that we can continue to get funding to offer you these free trainings and webinars. So please complete the survey and return it to us. Also, as a bonus for attending today's webinar, you will receive a certificate of completion. Now, as I stated earlier, today's event, we will examine how to overcome barriers to housing and access to credit. And we will also explore how lawmakers and community groups can come together to collaborate on solutions to this crisis. Why? Because in the United States, approximately 26 million Americans are what they call credit invisible and unscorable. Without a credit score or with an inaccurate lower score due to credit reporting errors, it is challenging for these consumers to access credits, loans, including mortgages, and get rental housing. And with a limited housing market with few affordable or accessible options, consumers are pushed into substandard or unaffordable homes. And when the housing costs are more than a household can afford, this leads to foreclosure or eviction. And foreclosure and eviction can impact consumers way beyond just the immediate loss of a house. It can push the households into poverty and homelessness and hinder their ability to attain housing in the future, impacting their health and their children's health. So get ready to be amazed because we have with us some of the top experts in the field today who will be tackling these issues for us today. We have with us Gabe Durrell. Gabe is the president and CEO of the Homeownership Council of America and thought leadership and solution for underserved communities and home ownership. He serves this work by providing vision, technical assistance, and lender services to community development, financial institutions, and investors in affordable and minority lending. He currently serves on the Mortgage Bankers Association Consumer Affairs Advisory Council, and he was appointed by HUD Secretary Marshall Fudd to the Housing Counseling Federation Committee, and he's currently serving his term. Welcome, Gabe. Also with us is Mia Eyes-Rubelee. She is the director of the Disability Justice Initiative at the Center for American Progress. Before joining American Progress, Mia advocated for disability justice and inclusion at nonprofit organizations and businesses across the United States. She has worked with the Women's March, Families Belong Together, DC Action Lab, Adoptees for Justice, and Fair Fight, and numerous other progressive organizations. Welcome, Mia. Mike Kropowski is here. Mike is the National Low Income Housing Coalition National Campaign Director. Before joining the organization, Mike was the executive director of Opportunity Dallas, an organization that's focused on building local coalitions in Dallas, Texas on promoting greater economic mobility by tackling concentrated poverty and segregation through housing policies. Welcome, Mike. Kevin Rabin is here. Kevin is the Director of Litigation for Three Rivers Legal Services in Gainesville, Florida. Kevin focused primarily on rental housing, both private and subsidized, fair housing, and consumer law prior to becoming the Director of Litigation. He currently serves as the co-chair of the Florida Housing Umbrella Group. Welcome, Kevin. Chi-Chi Wu is in the house. Chi-Chi Wu is a staff attorney at the National Consumer Law Center. As a staff attorney at the NCLC, Chi-Chi focuses on consumer credit issues, including fair credit reporting, credit cards, refund anticipation loans, and medical debt. She is the co-author of NCLC's Fair Credit Reporting Treaties and contributing author to Truth and Fair Lending, Credit Discrimination, and Consumer Credit Regulations. Welcome, Chi-Chi. Now, let me go over the roadmap quickly so you'll know exactly where we're going today. Today's presentation will be divided into two segments. The speakers have been asked 4 questions. Number 1, identify the barriers to credit or housing. Number 2, where's the data? The speakers have been asked to assume that everyone on this call is from Missouri, Missouri being the show me state, and they've been asked to provide us with proof that the items they identified as barriers are barriers. Question 3 is about common sense reform. The speakers were asked to identify any common sense policy reforms that, if implemented, could eradicate the barriers. And number 4, how can we all work together? How can we bring public and private, local, state, and federal government together to restore the trust to eradicate the problems? The speakers will answer questions, the first 2 questions in the first segment, and question 3 and 4 in the second segment. So starting off our discussion today is Gabe DeRio. Let me make sure that I give him control. But Gabe, thank you for joining us. It's an honor to have you here with us today. You've been in the business a long time. I think I met you like 15 years ago. I know you've seen a lot, but as the president and CEO of an organization whose mission it is to develop and expand homeownership through well-designed products, programs, and delivery systems, I'm sure you come face to face with consumers who have barriers to credit that hinder their ability to obtain housing. Can you identify a few of those barriers and, again, treat us like we're from Missouri and show us the proof?
Absolutely, Linda. Thank you for having me, and glad to be here with everyone. I think we need to get the controls passed over to advance the slides, though. Let's see if I can do it. There we go. Great. So I'm going to talk to you a bit. Obviously, being a Homeownership Council of America, my focus is going to be on the barriers to homeownership credit. We're going to take a high-level overview of the homeownership gap to sort of set the stage of what the results of barriers to credit look like. And then we're going to dive into the reasons behind that and take a look at some other data for some additional insights into what we can do. Let me see here. Sorry, I'm trying to click forward. All right. I don't think it's quite clicking for me, Linda, but if you're doing it, that's great. This is our mission statement: building more equitable access to homeownership credit for America's underserved communities. And how we do that is we work with CDFIs, lenders, that includes banks, independent mortgage banks, investors, and others, even home builders, to build low to moderate income and BIPOC credit access. BIPOC, for anyone who's not used to that term, stands for Black and Indigenous People of Color. It's a sort of a catch-all for minority and a new term for that. That isn't as I suppose speaks down when you say something like minority. So LMI and BIPOC credit access are what we really focus on, and we do that by building products and mortgage delivery systems with those partners and among community organizations and lenders. So a little bit more about HCA. We're a national nonprofit organization. We serve our mission through our services, primarily through our CLIMB program, Community Lending Initiatives in Mortgage Banking, and our new equity programs. And I'm going to tell you a little bit about those in the solution section. We have a uniquely experienced team. We are folks that have been doing this for a long time. Our management team has, we counted it, we think we're over 150 now, 150 years of experience in mortgage lending, nonprofit housing, including development and ownership, HUD-approved services, and CDFI management. And we bring that team together to work with our partners and really help to transform each organization and company that we work with, building concrete solutions, real product offerings in the market, and sort of making lemonade out of the lemons that we have each year and in order to serve the mission. Let's take a look at the homeownership gaps to start with. I thought we would take a look at this from a national perspective. And, you know, our organization worked with a partner, we can go to the next slide, Polygon Research, to put together this state ranking of each state when it comes to the homeownership gap from a racial perspective and an ethnic perspective. So we took a look at the American Community Survey data, and we sourced that from PUMS or iPUMS. And so we're giving you the methodology here. We're going to share the slides, so I don't have to spend too much time on that. But this is the standard way to calculate homeownership rates and to look at the gap that may exist among different groups. So we took a look at that gap, and that results in the map. Here we go. I think I've got my clicking working. So, so what you see here, I'm going to just quickly flip through these slides because you can spend more time looking at it. in the deck itself, and then I'm going to end on the rankings in columns in the data. In the data set. So what you're seeing here are the darkest states are the biggest gaps. And right now we're looking at American Indian and Alaskan Native homeownership rates. They get grouped together in the ACS or in the census data. And so that's how we see that there. And you see where some of our darkest areas are. You're going to see some of those darker areas continue through as well. So this is taking a look at Asian homeownership. I would say even when you're looking at areas in Asian homeownership, because there are so many ethnicities within the Asian racial category, there's so many ways to look at that. So it can be a little deceptive when you look at it on a local level or a national level. But we work with the data that we have, and we can certainly see big gaps here. Moving on through, this is Black or African American. You can see a lot of our dark states that were dark in the last two slides are still really dark in this. So really big gaps among what we might say BIPOC, right, among minority categories. And certainly if we're all reminded of George Floyd and him giving his life in that way, frankly, that is the biggest gap. And so it's not surprising that his home state has the biggest gap. That has really, I would say, though, advanced a lot of discussions in home lending and really brought to bear the solutions that we're implementing today. So all is not lost or was not lost for that sacrifice. This is looking at other or two or more races. So, oftentimes people look at the HMDA categories or survey categories. HMDA is Home Mortgage Disclosure Act, so that happens in mortgage lending. I'm going to use that data in a little bit. But even when you're looking at surveys like the American Community Survey or the census, you may not find yourself, so to speak, in those categories. And so a lot of folks land in the other category or two or more races. And so what's interesting here is some of our dark states are still really dark. Some of them aren't so dark in this case. And places like New York and Pennsylvania and New Jersey, which are quite diverse places, show up a much larger gap in this other or two or more races category. Finally, I think this is our last one, Native Hawaiian or other Pacific Islander. It's a big wide set of group of people to put in one big bucket there. But again, we're working with the data sets that we have, and you can see that we have a very big gap in many places across the country. And this also tracks with where folks live. Oh, finally, we have, so those are the racial categories. Now we have the ethnicity category of Hispanic or Latino. And so you can see the Latino homeownership gap. Again, here, some of these gaps may be with lower populations, but this is based on a population percentage. So you're seeing a sort of per capita distribution of homeownership. This is the rankings here. By the way, if you want to see this whole data set and the entire spreadsheet, you can download it from our website. Just look for the state rankings link on homeownershipcouncil.org. This right here shows you a snapshot of the bottom 20. So you can sort of see, who were in our 50th. We have 51 in a lot of the categories because it includes DC. So you've got Vermont as the lowest ranking there for American Indian or Alaskan Native, Native American. State rank for Asia, North Dakota being the worst, Wyoming being the worst for Black or African American. Then you've got the other or two more or more races, North Dakota, Minnesota for Native Hawaiians. You've got the Hispanic or Latino being North Dakota. And then for non-Hispanic white, the biggest gap is Hawaii. So that just sort of shows you we did add that in there to compare against non-Hispanic white. You can get to that whole ranking list and check it out. But I started there just to say that is the result of barriers to credit and the barriers to accessing credit. Whether those be individual characteristics or systematic characteristics, the result is that we have a bigger homeownership gap than before the Fair Housing Act was enacted. Before ECOA, Equal Credit Opportunity Act, was enacted. So the gap is ever present. It's gotten worse over the last few decades. And as someone who spent much of my time working on low income issues, I really have broadened and more deeply focused on racial equity issues, because frankly, when we work on just affordability, it potentially just widens the gap, because more often than not, a non-Hispanic white person is achieving or receiving that benefit. And that's what it's looked like for decades upon decades. And the results are that the gap is bigger than it's ever been. And I certainly don't find that acceptable. Another piece that's driving this gap is where you could see on the map some of those darker areas also are some of our most affordable states in the country, where housing prices are the lowest. And so you have to ask the question, if we have opportunity at housing price, then why haven't folks been able to achieve that opportunity? And another aspect of a sort of systematic or lending aspect here in homeownership credit is that small mortgages for single family residences are by and large difficult to get, we could say. What we're doing here is we're citing the study from the Urban Institute, but it shows a significant lack of financing available for low cost homes. And so the bottom line is that a mortgage pays a percentage as revenue, and a small loan drives a smaller revenue. And so there are lenders who don't participate in loan sizes below X. And that means that we've got a lot of communities around the country where we have cash buyers, or folks that don't need mortgage financing, buying those inexpensive homes, but we are losing the opportunity for standard consumers who would and can afford those homes when they can't get a mortgage to buy that $100,000 home or that $150,000 home. Help make that picture a bit more regionalized, we did another study with our friends at Polygon, where we took a look at the lowest 10th quintile of loan sizes. So we were looking at all of the mortgage production, and if you were to split that out into 10% chunks by loan size, we looked at the lowest 10%, okay? And so then you're seeing the sort of very end of the bell curve, where the least amount of activity is in that 10% quintile. And those are the lowest loan sizes. And so that's how we sorted those quintile sets. And so when we did that and overlaid and sort of grouped states together, we could see that a small loan meant something different in different states. And so we put this map together to help the lending industry sort of approach this issue and understand that if you are working in Illinois, you may have a different small loan number than if you're working in Texas, or for that matter, on the West Coast. And so you see here that small loans really range from $85,000 all the way up to $245,000, and it really depends on the market. But those loans that are considered small have the least amount of lenders that are active in that market, and that is absolutely a barrier to access credit for affordable homes. So next, I'm going to dig into the data a bit more, and really into the mortgage data, at least at a high national level. Linda's question of where's the data, I wanted to make sure we stop and say where is all this from, where are we getting this? Well, good news is it's public. The top four there are all public information. So the census, the American Community Survey, and then HMDA data, which is the Home Mortgage Disclosure Act. And we use HMDA LAR data, which is also multi-year. At our organization, we partner with Polygon Research. They're one of our data providers, where we pull a lot of the census data in their Census Vision, and we pull the HMDA data in their HMDA Vision set. That's a subscription service, and it helps to pull it, sort it quickly. But all of this information is free and publicly available. Some other helpful sources we listed here: Urban Institute. We are always guided by their research, and always look forward to the next sets of studies that they bring out. They always bring insights for what we should be working on. The GSEs, both Fannie Mae and Freddie Mac, have a great deal of research on their websites and a great deal of data tools as well that you can use. You can dive into different markets. You can slice and dice those markets in a variety of ways. And they also tie into some of those public data sources I just referenced. Last two on here, Federal Reserve has really great research. We have cited their research and data many times in working on special programs or low income programs. They also help you see things like savings rates among different ethnic and minority categories. And that helps you to understand where you have to meet people where they are. And so that's really great and useful information. And then finally, our friends over at iEmergent. iEmergent provides mapping tools and also a great deal of data sets, not only the public data sets I referenced, but they purchase a lot of data that shows all of the loan closings, shows who closed those loans, showed who are the realtors who closed those transactions, where all the community organizations are, etc. We find them very useful for lenders who are working to reach underserved communities. So into the data here. So something we wanted to just, I thought I'd put this slide in here really just to show you what you can get in some of this data. So this is taking a look at census data and American Community Survey. And again, you can see, and this is the whole country, so we can see the number of households here. We also could sort that by people. So you can change and see number of individuals, number of households. Then you've got all of the ethnic and minority categories or ethnic and racial categories on the column there going down. So you see non-Hispanic Black, non-Hispanic White, Hispanic White, etc. Going down the line. And then going across, you can see how many households represent that group, what the average income is in that group, what the average household size is, and then the ownership rate, the home ownership rate. So you can easily see the gaps here among the racial and ethnic categories when it comes to home ownership, but there's a great deal of information in the survey and in the census data that's very useful. So are lenders and mortgage credit, is mortgage credit reaching communities of color? And so when we take a look at that, here's another way. And of course, I'm doing a helicopter tour of a few cool data that tell a story that I could bring to you briefly today. But this one we find terribly interesting. This is a redlining analysis. And what this does is it takes a look at census tracts and how many, what the percentage of minority population is in that census tract, and then tells you how many lenders are actively lending in that tract and how many applications have occurred for mortgage credit. And then we take a look at how that compares to other census tracts and sort of the population. So does the application count by percentage of population reach that same census tract? And so what you see here on the red flags all the way to the right on that first graph are that when we see, and this is looking at a national level, but I would say we look at this locally a lot in a variety of markets around the country, and usually the greater than 50%, so the 50 to 60% will also usually have a red flag on it. This is looking at a national level where it didn't, but what you're seeing here is that as the percentage of minority population increases in that census tract, you'll see that the number of active lenders decreases, and the amount of applications per capita or per person decreases. And so that is what we call redlining risk, because you've got an area and a people that are not receiving a penetration of lender credit and are therefore applying for potential credit in that area. And so that's sort of a first cut of how we can see if lending is reaching populations in certain areas. This next one, that's at the application stage. So are we getting people in the door? Did we overcome the trust gap and the information gap that exists? And did we at least get a credit program in front of someone, and so that they could understand they had access to apply? That's what that first set does. The second set really shows us origination. So of those that applied, what pulled through and what actually closed. And so we can see again more redlining risk there, in that we don't see the closing rates per population that we see in other areas. And so we do see increased denial among BIPOC applicants and in BIPOC areas. Let's see if I can get the, sorry, Linda. Yeah, we can go to the next one. So this is taking a look at cost burden for BIPOC borrowers. So we dialed out the BIPOC borrowers in this, and actually no, we can show you white against, so that you're seeing non-Hispanic white against other racial categories here. And what you're seeing in this analysis is that, and I wanted to share the data, that you can actually see this information. You can see the total loans that were made, the total number of loans, the average loan size, the average combined loan to value. That's what that CLTV is. So how many, what were the total liens against the property, and what was the percent of that against the property's value? What are the net charges and credits? So basically the charges, unless that's a negative number. What's the average interest rate that was offered or closed? What were the discount points used or paid in order to get to that interest rate? Those are discount points are closing costs, unless they're paid by the lender, but there would still be a closing cost. And then you've got lender credits. So this would be credits provided to the borrower to pay some of their closing costs. You see the origination charges, so what the borrower was charged in order to originate that loan, and then the average closing costs in total. And then finally, you see a rate spread. So that would be the difference between the best rate and the rates that were offered. And so what you see when you look at BIPOC borrowers is that, first of all, that BIPOC borrowers received fewer loans overall. BIPOC borrowers also had higher closing costs, and they had a greater rate spread, or in other words, higher interest rates. So we've got, not only do we have folks who have barriers to just reach the point of applying to credit, but within the credit application or delivery, you've got folks that are receiving higher interest rates and costs. So the last, I think this is on the sort of barriers, but the next thing to look at here is the denial rates and reasons. So really we looked here, and in the top left-hand corner, you can see at the odds ratio of being denied, and you can see they're sorted by racial categories there. From this particular report, but you can see that, for instance, Black or African Americans have a 2.4 times more likely, or 2.4 times more likely to be denied than their white counterparts. So we look at the, go back, we look at the reasons for that denial. Let's go back one slide to the donut there. And then you'll see, you see the donut has all of the reasons for denial. Debt to income, I put national on the top right corner there as well, so you can see that when we're looking at BIPOC on the reasons for denial, it's not terribly different from looking at the overall population. But debt to income is always the first reason, or the biggest reason for denial, and that's driven by having too high of payments versus their income. And there's obviously a lot of factors and variables that go into that. Credit history or score, which I know some of my counterparts here are going to talk about, is the second biggest reason for denial. Collateral, or the home not appraising or inspecting, would be the third biggest reason there. And then you can see on down the line, credit application incomplete. That really has to do with folks not being ready for a mortgage application, not having all of their documents, and being able to complete the process. Unverifiable information, this happens a lot in communities of color and ethnic communities, where some of the documentation may not be standard. And so this is a reason, and one of the reasons why lenders need to get more and more diversity in their credit policy and underwriting to understand and meet people where they are. But there's a great deal of unverifiable information out there. And then insufficient cash, which is a big one. So for all of the down payment assistance programs out there, closing cost assistance programs, that is the slice of the pie that it can solve sort of immediately right there, is insufficient cash to close. Also, you've got some employment history and then a little tiny bit for mortgage insurance. So last slide here for me before we get into solutions, but I guess I wanted to leave on a bit of a positive note in that, you know, we are moving in the right direction finally. Much more is needed, and we're going to talk about that in the solutions segment. But what you can see in this, or in the left-hand side, these are BIPOC applications by year. So we did all of the everything except for non-Hispanic white. And you can see that the total number of applications is significantly increasing. And we really took a step up in 2020 and again in 2021. Those kind of big steps up are what we need to be taking in order to narrow the gap and close it one day. What you can see on the right is you're seeing actually all of the racial categories, and you're seeing each year by volume by the racial group there. And I think with that, I'm going to turn it on to my colleagues to take the next cut at barriers to credit.
Thank you, Gabe. We're going to move on to Ms. Chi-Chi Wu. Chi-Chi, back in last year in 2021, you testified before Congress, and you described to the members how a biased, broken credit reporting system riddled with mistakes is hurting American consumers. And as far back as 2010, when you testified before the EEOC, you told the commission and its chair that the use of credit reports as a screening tool for employment is hurting the American worker. Please, during your presentation, can you kind of describe for our audience how credit reporting system and the use of credit reports as screening tools can become a barrier for American consumers?
Sure, absolutely. I'd be happy to do that. Thank you for having me here, Linda. For those of you in the audience, you may notice I am a bit congested. I am under the weather, so if I don't make sense or am incoherent, you know why. But hopefully we'll be able to plow through this. Next slide, please. Am I running the slides?
I'm moving the slides. You need the next one?
Yes. Can you go to the slide that just says National Consumer Law Center?
There you go. It's up.
Oh, okay. I'm not able to see that slide. I think I also have an unstable internet connection, so my apologies to everyone. So the slide should say National Consumer Law Center, and it's just to give folks a little bit of background about the organization that I'm with. We are mostly do policy and advocacy work. We provide a lot of different types of written material, legal treatises, policy briefs. Most importantly, for the folks in the audience, we do provide technical assistance to attorneys and advocates when you're helping individual consumers. We don't provide direct services or advice to individual consumers for various reasons, but if you're working with a consumer and have a question for us, feel free to reach out. As mentioned in my bio, I primarily work on credit and consumer reporting issues. Next slide, please.
It's up.
So, great, thank you. So I was asked to talk about barriers to credit, and focusing on credit reporting and credit scoring issues as I do, of course, the barrier I want to talk about is credit reports and credit scores and the barriers created by the big three credit bureaus, Equifax, Experian, and TransUnion. These three companies form an oligopoly, which basically controls the financial lives of American consumers. And they're worse than your average oligopoly because unlike Verizon or Sprint, where at least you can choose between the handful of big players, you can't choose between Equifax, Experian, and TransUnion. If you want credit, or oftentimes even mental housing, insurance, or a job, you have to deal with all three. And because they are in this powerful position, the credit bureaus just haven't been very good to consumers. And this has been going on for decades. So back in December 2012, the Federal Trade Commission issued the definitive report on errors in credit reports, and found that 1 in 5 consumers has a verified error in their credit report, and 1 in 20 consumers has an error that is so serious that it could be denied credit or it could cost them more. And I've been doing this part of the presentation a lot. If you've seen me at other consumer action in-person conferences or webinars, I've talked about this. But the most recent data to come out is in January 2002, the Consumer Financial Protection Bureau issued a report noting that in a 20-month period, 700,000 complaints were filed with the CFPB against Equifax, Experian, and TransUnion. 700,000 in a 20-month period. That's huge. And that's by far the largest category of complaints filed with the CFPB. I think it's 58%, it's over 50% of the complaints. Also this year, the Senate Select Committee on the Coronavirus did an investigation and reported that consumers disputed 336 million items of information on credit reports. 336 million. Now, many disputes include more than one item, so the number of disputes is more in the tens of millions range, but still, that's a huge number of disputes against these three companies. And again, it's because we consumers, we have very little control over the information that goes into credit reports, very little say. Our information is the commodity, and we are not the customers. Next slide, please. Another barrier to credit is the fact that when consumers do have errors in their credit reports, it's very hard sometimes for them to get them fixed. The dispute system mandated by the Fair Credit Reporting Act to correct errors is really dysfunctional. This slide, by the way, that I'm showing you, I showed at a consumer action in-person conference back in 2014. And what it represents is that the credit bureaus will take a consumer's dispute, maybe something they've spent hours on writing a letter or assembling documentation, taking to the post office by sending it by certified mail, and they'll translate that dispute into a 2 or 3 digit code and use the same codes maybe 70 or 80% of the time. So a consumer might say, I don't owe this debt. In fact, there's a court judgment here dismissing the debt collector's lawsuit against me with prejudice, meaning it's a conclusive disposition because they got the wrong person. And there'll be a letter and a copy of the dismissal, and that'll be sent to the entity that provided the information, called an information or a data furnisher. And it'll be sent with a code. And at least now they'll be sent with a scan of the documents. It used to be that the documents wouldn't be sent at all. Now at least the documents are scanned so that the debt collector has them at its disposal. But still, if the debt collector comes back and says, you know what, the consumer does owe this debt, we're going to verify it, then oftentimes the credit bureaus will just accept that. They'll parrot the information furniture. It's like I liken it to a judge who always rules for the defendant, and it's called parroting. It's something we wrote about back in 2009. Since the CFPB was created, and as a result of a settlement with the attorneys general back in 2015, things have gotten somewhat better. But it's still a big problem, and we still hear lots of examples of people unable to fix errors in their credit report. And the 700,000 complaints to the CFPB and the tens of millions of disputes gives you an idea of that. So that's one barrier to credit, which is the problems with the credit reporting system. Next slide, please. So as Linda Williams discussed in the introduction, another barrier to credit is folks who don't have a credit record at all. As bad as these big three credit bureaus are, if you don't have a record with them, it's a problem if you're credit invisible. And 26 million people are credit invisible. Another 19 million are what are called thin file consumers. They have such little information in their credit reports that they can't generate a credit score. These consumers are disproportionately Black and Latino. This is a chart from the CFPB showing the racial disparities in terms of who's credit invisible. And it's certainly a problem. Now, there's been a lot of focus on credit invisibility and try to help credit invisibles since this report came out in 2016. But as I'll discuss later, some of these efforts, there should be a cautionary flag because they can also end up hurting consumers. And frankly, there's a fate worse than being credit invisible when you're talking about credit histories, and that is having a bad credit record. So next slide, please. So in terms of looking at folks who do have a credit score, Black and Latino consumers also have lower scores as a group. There's study after study showing this. And this is likely due to factors such as the racial wealth gap and historic legacies of discrimination, of redlining, of outright racism, as well as the impact of that over the decades. But it's pretty dramatic, some of these disparities. For example, the most recent report from 2019 by the Urban Institute found that over 50% of white households had a FICO score above 700, which would be prime, compared to only 20% of Black households. So this is 5 studies that have shown these kind of racial disparities. Next slide, please. There's a bunch more studies, and these older studies, all of the studies except for the 2019 one are listed in a policy brief we wrote called Past Imperfect. And the PowerPoint deck has links to all the reference materials that I have in this presentation. Next slide, please. And speaking of using the past as to sort of gauge the future, we should be on a slide that says the vicious cycle of using the past. So speaking of using the past to gauge the future, another barrier to credit might be this whole idea of using past payment history to predict the future, because it sets up a vicious cycle. Someone goes through a period of financial distress as a result of circumstances outside their control, such as maybe they got COVID and lost their job, or maybe they lost their job because of the pandemic. They weren't able to pay their bills. As a result, they end up with a bad credit record. And that bad credit record, as you'll see in a little bit, unfortunately impacts more than just their ability to get credit. It impacts their ability to get a job, their ability to get rental housing and insurance. And that inability to get some pretty important financial factors in life keeps their credit score and credit history down, creating a vicious cycle. Now, this particular slide also talks about how impaired credit can also be a drag on the whole economy when a lot of folks have impaired credit. The report I wrote about this was from 2013. I noted that in that report that there was some data showing if a consumer has a credit score of 600, which is considered subprime, about 20 to 30% of those consumers will end up defaulting on their credit obligation. But that means 70 to 80% would have been good borrowers if they'd been given credit. So we know that credit reporting and credit scoring is a very blunt, imprecise tool. And as I said, this slide is from 2013. Now, in the pandemic in 2020, 2021, we did not see a big drop in credit scores. And we think this is because a lot of folks didn't struggle financially because they got assistance. If you remember, there were several rounds of stimulus payments as well as advanced child tax credit. There was a student loan pause. There was PPP loans. People got money. They got relief. And as a result, their scores didn't plunge. And so what you're really looking at is credit scores being a measure of folks have money, they're able to pay their bills, their scores stay up. They don't have money, as in the Great Recession of 2008 to 2012, and their scores plummet. So really, is this the best way for us to judge whether to give someone credit or not? And we are starting to see credit scores start to dip down because we are, some of that assistance is running out. The relief is ending. So next slide, please. So we should be on this slide saying barriers to credit create other barriers. Linda, is that what is up?
Yes.
Okay. I'm seeing a slide behind, but that might just be my computer. Okay, so the reason that credit scores and credit reports can be such a barrier, including to housing, is that unfortunately, credit reports and credit scores are used for a lot of important financial determinants in a consumer's life that aren't just credit. So about half of consumers use credit reports in at least some jobs. Now, they don't use scores, but they use credit reports. Credit reports and scores are used for rental housing and insurance. And by the way, we know that for insurance and for employment, having no credit record is probably better than a bad credit record. That's not true for rental housing. Next slide, please. So the industry tells us that 90% of landlords use credit information in screening tenants. And we know a lot of these landlords use credit scores, not just the underlying report. This is having a huge impact on low, moderate income tenants of color, and certain vulnerable populations. For example, domestic violence survivors, this has having a huge negative impact on them because a lot of domestic violence survivors have impaired or bad credit because they were subject to financial abuse by their abuser, or their abuser, or they have coerced debt where their abuser made them sign up for credit that the abuser used, even though it's in the survivor's name. This has a particular impact on refugees and immigrants. Just last month, my hometown paper, the Boston Globe, wrote about the problems refugees and immigrants have with finding housing, and noted that many recently arrived immigrants, especially asylum seekers and the undocumented, are not eligible for most forms of government assistance, and they don't have credit histories required to rent an apartment. Frequently, that forces them into under-the-table arrangements with family or informal sublease agreements with a tenant. So, and I've heard from other folks working with refugee populations that credit history is a huge barrier for them. And of course, it has implications for tenants of color, given that, number one, as a group, Black and Latino consumers do have lower credit scores or are more likely to be credit invisible, because credit invisibility is a problem with respect to landlords. And that raises fair lending implications, of course, because, you know, using a policy or using a tool that has racial disparities isn't necessarily a violation of fair housing laws if there's a good reason for it. But credits, I would question whether credit histories, credit scores, there's a good reason for using them by landlord, because credit scores are designed for one thing and one thing only: to predict the probability that a consumer will be 90 days late on a credit obligation in the next 2 years. And I'd emphasize credit obligation, because we know that rent is a very different obligation from, let's say, a credit card or car loan. Consumers will pay rent before anything else. There's a saying that Matthew Desmond, who wrote the book Evicted, coined: the rent eats first, which means consumers pay rent before everything else, including food bills. So the fact that a consumer defaulted on a credit card obligation should have no predictive value whatsoever on whether they're paying the rent. And yet here we have credit reports and scores as a barrier to housing. So that's my last slide. I'm going to turn it over to the next speaker.
Thank you, Chi-Chi. Thank you. Feel better. Our next speaker is Kevin. Kevin, I'll be really quick. You and I had an email discussion a couple of months ago about the unlawful detainer process, the eviction process in some states, and how it can become a barrier for seniors. I was an eviction defense advocate in my past life, but before my conversation with you, I didn't see it as a barrier. But after my conversation with you, when I picture my 94-year-old mother in that situation, I can see it as a barrier. So during your presentation, if you get a chance to please, just describe for our audience how we can be a barrier. And I am going to give you control. And you should have control. Just go around in a circle, push down. You should have control.
All right, let's see if this works. Let me try. Down. Oh, yep, it does work. Hey, there we go. Hello, everyone. I want to thank Consumer Action for inviting me to be part of this panel. My name's Kevin Rabin. As Linda introduced me earlier, I'm a legal services attorney in the state of Florida. I practice in Gainesville, but all over North Central Florida. And as Linda mentioned, a lot of what we're talking about with barriers to credit and housing are going to provide an even more unique impact on older adults. And we're going to try to go over these topics pretty quickly because I think they're very common barriers you'll see for other populations, but I want to distinguish how these unique barriers for housing and in some ways credit access can impact the ability for older adults to remain in a home and live independently. And in kind of summarizing the 4 areas we'll cover, the first is housing affordability. The second is housing availability, eviction and screening policies, as Chi-Chi already touched on. There's plenty of issues to discuss there. And finally, access to and maintaining home ownership. So housing affordability for seniors and older adults is just different. We're talking about people who primarily live on a fixed income source. For a lot of the client eligible people that my organization represents in direct client services, these are people who are on Social Security, supplemental security income, or Social Security disability income. But this would also include anyone who's living on pension benefits, retirement benefits like an IRA, and any other form of fixed income that does not increase at we'll call it more proportionate rate with wage growth. Cost of living adjustments are about the only way that most of our older adult clients see an increase in their income. And I think all of us are familiar with what the impacts of inflation over the last year have been, but it's important to talk about where inflation hits you, right? And I think the most useful piece of data to talk about is the coming cost of living adjustment for 2023. As the slide indicates, we are going to see an 8.7% increase in benefits for Social Security, SSI, and SSDI recipients this coming year. However, that's only meant to capture the overall consumer inflation that has been seen across the broader economy. That isn't keeping pace with the specific type of inflation that is seen in increases in rent. And for older adults who rent, and that is a growing proportion of older adults, they have seen rental increases of 15 to 25% in hot migration places, primarily which have been focused in the South and the West. I live and work in Florida, and being where we are, the city of Jacksonville is always a very interesting place to look, where rent and price increases have been going up as much as 30 to 50% across the city in a single year. Those kinds of increases, no cost of living adjustment will keep pace with. And if your rent is jumping by 30% in a single year and your income isn't keeping pace, the likelihood that you fall behind on obligations, or more importantly, that you see a cascading effect across every form of expense you have, whether it's housing, food, utilities, or any other related expense category, is going to be a huge problem. There's also some other long-term effects that we're starting to see the effects of at this point. The loss of retirement income options has really been a profound one. I think, for a lot of the silent generation, for folks who had their, retirement accounts blossom in the 50s and 60s, they were able to see and live out many of their retirement years without having to worry too much about their stable income sources. They had been able to put aside money, and there were pension guarantee programs that grew and were able to help them maintain income when they exited the workforce. That's not as true now. And I think we've all seen this happen, especially after the Great Recession, that there have been a ever-shrinking number of private options that most consumers have access to maintain income in their senior years. Increasingly, most people are finding themselves relying on Social Security and a very limited subset of private retirement tools, like something like a 401k. And so as a result of that, and for folks who had to eat into their 401ks to keep their homes afloat during the Great Recession and the mortgage foreclosure crisis of the late aughts, we've seen a lot of those people now lacking the resources to handle a new crisis 10 years later. There's also, I think, another effect that happens for older adults who own their home, which is the increased costs in owning and maintaining housing. It's easier for me. I'm in my 30s. There's a lot of things that I can do in order to try to afford a new roof if that comes up. I have, better access to credit. I have the ability to finance that if I need to. But for an older adult who may not have the ability and the debt to income ratio to sustain that, they're going to face more limited options to take those needed repairs and ensure that they can remain in their homes long term. The other thing that we'll touch on is housing availability. There has been a decrease in affordable housing across the United States over the last couple of years, and this has happened both in single-family homes, detached dwellings, and multifamily apartment complexes, condos, and other multifamily construction. One of the biggest ones is the low development of affordable homes over the last 15 years, and we'll look at some slides in a minute showing the specific rates on home starts, but single-family home starts have been in a huge decline ever since the boom of the mid-2000s that led to the Great Recession. The other problem is most of the home construction starts even now are not focused on introduction, homes. These aren't starter homes for, most people with 2 or 3 bedrooms. These are more lucrative developments for developers who now find increased costs as part of the overall budget that they have to account for in developing homes. And I think we would be remiss if we didn't mention that the loss of public housing and other subsidized housing from the stock of potential options is a huge problem. There's just not the congressional willpower to pay for subsidized housing the way there was 50 years ago. And because of the lack of funding for public housing, there have been options to try to find ways to keep and maintain and preserve that kinds of affordable housing, but many new construction options don't exist in the subsidized housing arena. And what is being created is no longer as deeply subsidized as it once was. So it's important to note that the amount of available options has dwindled. This is coupled with the fact that housing is more expensive than it's been in a long time as a share of income for most people. And it's driven a competitive market that only began to abate several months ago. We were seeing price increases in Florida of over 50 or 100% between 2020 and 2021. Homes that sold for 200K would sell for 320 the next year. And if that's the competitive marketplace you enter, the amount of options you have to acquire affordable housing decreases as competition increases. Moreover, there's a few other pieces of this puzzle. As people are pushed out of the ability to rent their own homes, we've seen an increase in rent by room models, which is a little strange in the South where we have a lot more land and our urban density has never been as great as the Northeast per se. But this is more lucrative if you are a multifamily developer because renting by the room can potentially net more income than renting an entire apartment. I live in a college community. This is a really lucrative model for students, and that unfortunately has become more commonplace as a model for older adults as well. And for a lot of older adults, it may be the only option they can find that fits their income. Another huge impact that we've seen and a barrier is, as Chi-Chi mentioned, the growth of screening through the use of credit reports and other forms of consumer reports from CRAs that specialize in tenant screening. As Chi-Chi mentioned, there's not a lot of probative value a credit report has on whether a tenant can afford rent. And that's even less true for an older adult, because if they're on a form of protected income like Social Security or pension benefits or retirement income, none of that money can be reached by creditors if a consumer doesn't want to pay it. The sad truth of what we tell a lot of our clients who are older adults is, yeah, if you fall behind in debt, you don't have to worry because they can't garnish your wages. You don't have wages. Your money comes from Social Security. And as long as you're spending what you receive and you're doing so in a timely fashion, which most of our clients do, you're not going to be at risk of losing those assets. And I think that's something that gets overlooked in these uniform tenant screening tools, is it assumes that everyone is a flat wage earner and it ignores the differences in the lack of collectability that a lot of older adults have from other types of creditors, particularly credit card companies. And aside from that, older adults also see a lot of issues with false matches. We've seen a lot of examples where an older adult who is senior has a child named, that they'll say John Smith Jr., and these credit match issues come up quite often when, unfortunately their child maybe has a very poor credit history, and it can lead to denial simply because they share names, birth dates, similar Social Security numbers. And a lot of times we see issues with eviction filings. In Florida, we have a very broad open records law. It allows almost all of our court records to be made public, and that's great for us to be able to see what's happening. But it means that a lot of entities can scrape our court records and sell that data to screening landlords who will then decide not to rent to people simply because an eviction case was filed against a person, even though the case didn't conclude with an eviction judgment a court order that rendered the person, you know, for lack of a better word, guilty of not paying rent or for failing to abide by terms of their lease. And we've seen a growth in management companies that pretty flagrantly say that they do not care about the outcome of the case whatsoever. They just care if a landlord was frustrated enough to file a case at all. And that's obviously problematic because, as we hopefully all recognize, eviction representation in court is pretty limited throughout the United States. We're only now seeing a big growth in the right to counsel movement for evictions, and there's been some places where that luckily has passed. Washington State, New York City, and Philadelphia are really good vanguard examples, but in Florida, for example, over 90% of our court cases involve tenants who were unrepresented, many of whom were evicted by default or moved before any eviction actually occurred. And there's also a lot of other problems that pervade eviction and screening policies. And one of the biggest is that the tenant themselves is paying for these screening tools, right? And if you're an older adult paying a $95 application fee to be told that you can't afford this dwelling, how many of those can you really afford to pay to be told the same thing? That just makes this an even worse and more profound problem for people who exist on fixed incomes. And another big issue that we should be touching on is access to and maintaining home ownership. I think we often focus on trying to increase home ownership among people who have never had a home, first-time home buyers. But I think it can get lost very easily that being a first-time home buyer comes with a list of perils of how do you keep that home? How do you maintain your status as a homeowner and avoid the pitfalls that can lead you into becoming a renter once again? And I think for older adults who've never been homeowners, it's incredibly difficult. Again, we heard from other presenters, lack of capital, whether it's savings or other forms of cash that they could pay for down payments, points, or closing costs. Poor credit or the lack of a credit history whatsoever. Again, a lot of older adults grew up in a generation where credit was disfavored. Many of them were, very much taught at a young age, don't borrow money you can't pay back. And so there's a lot of people in that generation who lack a sufficient credit history, and it can deter them from home ownership. And the other thing for an older adult who specifically hasn't owned a home in their younger years, they may be inexperienced with what home ownership entails. The payment of property taxes, the maintaining of property insurance, in Florida, for example, flood and hurricane insurance, and the fact that you often have to go through multiple insurance companies to obtain each. But there's also, once a homeowner has home ownership, there's a lot of maintenance challenges, including insurance premium costs, the cost of replacing and maintaining major fixtures, again, dealing with the questions of inflation. The cost of the materials necessary to repair HVAC is pretty substantial. Can many older adults front the bill for $15,000 in those repairs? Probably not. You also have questions with escrow adjustments and understanding mortgage servicing issues. You see this all the time with things like reverse mortgages, but you also see them in forward flowing mortgages where if a person hasn't owned a home in their younger years, they may not be familiar with how this works, and they may be struggling with financial literacy and understanding the forms that they're receiving from their servicer. And I think one other giant thing that we've seen both in rental and home ownership is really accessing utilities. Utility costs have spiked all across the nation, due in part to COVID-19, the after effects of the pandemic, the financial instability, and the war in Ukraine. And as a result, we have seen increased utility costs with natural gas, electricity generation. And for many older adults, these kinds of utility costs become the biggest focal point of their budget. And so it can very easily become a question of, do I pay my electric bill or do I pay my house payment? And I think for a lot of our clients that we see, yeah, owning a home is wonderful, but if I can't run the lights, if I can't take a shower, it's not really worth a whole lot to me. And we've seen a lot of stress from that. So in terms of the proof, I think it's just useful to have some quick visuals to highlight where this is happening and how bad it is. The housing affordability part, how bad was the rent crisis over the last year and a half? Really bad, particularly in the South. One of the biggest boons that we've had as a legal services program is that there's been a lot more data research focusing on eviction and rent in the last few years. And I want to specifically shout out the Federal Reserve Bank of Atlanta and Cleveland for increasing the research they've been doing into the economic effects of rent and eviction policies across the country. This is pulled from Sarah Stein's research on housing instability and emergency rental assistance, but it highlights really glaringly how much increase was occurring and how much it's been focused in the South. You know, of the 50 cities with the highest rent increases over the last year and a half, it was primarily in the state of Florida. And so you see that this really falls on a retirement state more than it does almost anywhere else. And a lot of the places where net migration for older adults occurs is to these southern cities and these southern states. And again, the data from Redfin that's pulled here on the right shows just a general across the entire country increase in both rents and mortgage payments. And this is across all of the regions of the country. And I think it's a pretty profound one to see how quickly it rose and how quickly things started to become competitive for any form of affordable housing that could be found. Are things improving? A little bit. I mean, this is something that has been some good news. I think anyone who's been paying attention to the Federal Reserve and the interest rate increases knows that we've been seeing some very historic and quick climbs in base interest. And as a result, it has stymied some of the very dramatic growth in median rent across the country. And that has been really helpful. We have not seen quite the same crisis level that we were experiencing back at the beginning of this year. And I think the chart on the left shows that we maybe reached the peak of this at the very beginning of 2022. But you'll also notice that we're nowhere close to where we began this. You know, this is the kind of problem where the prices rise, but will they ever truly return to where we were at the beginning of the pandemic? And I'm not quite sure we will. The other thing is I highlighted that home energy prices are outpacing base inflation rates. And as a result of this, even though rents may be decreasing, one of the most important aspects of maintaining a house is your access to utilities, and that is becoming cost prohibitive, especially for low-income families and for older adults on fixed incomes. Let's see, it's not clicking through. So if we can go to the next one. So when we talked about housing availability, I do want to highlight and show a visual of one of the other subset of problems that are happening, which are what I call, or what we're, I think, all calling built to rent. Built to rent is a big investment opportunity for private equity, and it has become a big part of where the starts of new single family homes are occurring. And what used to be built for homeowners, used to be sold to homeowners at, you know, prices in the 80 to 150K range, depending on the community, are instead being rented because the rent market is more lucrative now than simply selling or going through the mortgage origination market. And this is something that is, again, a new trend. We had not seen this historically at any time in the US history. And I think it's important to keep an eye on how much this trend seems to be increasing. It happened during the mortgage crisis and the recession, but you'll notice right here at 2022, we're reaching a peak where that is happening yet again. And we'll talk about this in a moment, that may be causing other instabilities in home ownership. Next slide. Yeah, I mean, one of this is, again, the increased cost of acquisition is one huge factor. And again, this is just showing what the average cost across the nation to acquire a dwelling is. You can see that trend line has been going up pretty steadily ever since 2016. And the real peak happens after 2020, where we see costs increase from around $275,000 to settling where we are now, right around $375,000. Next slide. So this is, again, showing the new construction rate and housing starts in the thousands. Again, this talks about the question of how many people can actually find homes to rent or buy. Well, again, when there's only so many new constructions, and then we have population growth as a nation, there's only so many available dwellings. And when you have an increasing share of these new starts being focused on rental housing, it shrinks the home ownership market. It makes it more competitive. It keeps people in the rental market for longer, and it creates additional demand for rental housing. It creates a vicious cycle that feeds into the increase in rental prices and the shrinking ability of people to access home ownership. Next slide. So eviction and screening policies, this is something Linda and I talked about, that evictions have really grown as a thing. We've seen formal and informal evictions for years, but especially across the pandemic, even with the initial lockdowns, the initial phases of eviction protection, as soon as those abated, almost every single community across the United States saw evictions rise and rise dramatically. And so as rent prices increased, you also saw a commensurate increase in the number of evictions. Makes sense. As rent becomes less affordable, fewer people can afford to pay it. And again, that last one on the right just shows our community in Gainesville. This is drawn from the Eviction Lab. Again, Matthew Desmond and the folks at Princeton doing great work in tracking and helping us better understand what we experience. You can see the initial reduction in evictions that occurred in May or March of 2020 through July, commensurate with the CARES Act and the initial lockdown and pandemic phase. But Florida, as our governor made very clear, was reopened in July, and as those restrictions abated and rental assistance in particular started to get expended, and our state had committed almost all of its rental assistance by January of 2022, rent affordability became a huge problem and evictions increased dramatically above historic average. Next slide. So again, I think Chi-Chi touched on this sufficiently, so I won't reiterate it too much, but the no credit denial has become a huge problem. And this kind of affects both ends of the bell curve of both younger renters and older adult renters who do not have any form of real credit history or are minimal thin file credit files. I think the one thing I would touch on is there has been a growth in CRAs to try to collect payment information on rent to report it to help grow credit. I think for the reasons Chi-Chi mentioned, this worries me greatly. I think this is actually it's a huge wolf in sheep's clothing to say that we're going to collect a bunch of information about how people fail to pay rent timely and then make it even harder for them to access housing. Again, I don't think the problem is that we have too little credit. It's perhaps that we focus too much on credit for too many things. And so if we're just trying to increase the amount of credit people have and the amount of reporting about credit, I'm not certain it's actually going to help solve the problem. It may in fact deepen the crisis. Next slide. And so, yeah, I mean, when we're talking about maintaining home ownership, one of the biggest things is to see that home ownership for older adults is actively decreasing. Part of this is, again, the loss of the ability to maintain income in retirement. You see that, again, by race and ethnicity for ages 65 and older, as we've gone along through the 90s, through that initial peak phase in the height of the housing boom of the early 2000s, you see that we've been on this slow trajectory downwards, that increasingly older adults are finding themselves as a smaller and smaller share of homeowners, and that their home ownership rate by population is shrinking. It's not a huge trend line, and I don't want people to be alarmed that we're going to see a sudden, huge problem of homeless seniors or homeless older adults, but it's definitely growing. And the increased costs on communities at large from older adults not having sustainable housing where they can live independently is going to have profound economic costs across our communities, both local and national. And the final slide for this part is, again, foreclosure is coming. We have seen, we're definitely not where we were at the height of the foreclosure crisis in 2008, But as a legal services program, we have noticed an increased number of foreclosure starts. We're seeing more clients come to us who have been through several loan modification efforts that are not successful. And many of them are, at this point, finding themselves facing a foreclosure they can't necessarily prevent. There are some options to help, and the homeowners assistance funds that were part of the federal relief in 2021 did help prevent more of this from happening. But that money is being expended fast. In Florida, most HAF funds were committed in less than 3 weeks. And so as a result, we're going to probably see an increase in these as we go forward into 2023 and beyond. And I would say that it's something that we should all be alert to.
Thank you, Kevin. Mia, that article that you had published in The Hill last month is a great article. In that article, you indicated how the disabled community continues to fight high poverty rates due to ableism and other structural barriers to employment and economic security. During your presentation, could you please just outline a few for us? I'm taking control away from Kevin, and I'm giving it to you. Mia, you should have control of the screen.
Wonderful, thank you. Thank you, everybody. I'm so glad to be here chatting with you all about overcoming barriers for disabled people and accessing housing and credit. I know our time is pretty short, so I will try and keep it pretty tight, but I want you to keep sort of in mind, particularly with that question that you just asked around ableism and understanding that ableism is basically a structural paradigm that pushes the belief that disabled people are deficient and less worthy in society, which often results from intended and unintended social prejudice and discrimination, which can affect things like what society decides to spend its money and resources on, resulting in disabled people having higher rates of unemployment, higher rates of poverty, poor health outcomes resulting in higher medical debt and poorer credit, and fewer housing options. And as we also know, people don't live single identity lives, which means that ableism can interact in toxic ways with sexism, racism, xenophobia, homophobia, resulting in multi-marginalized disabled people, affecting them at even greater disadvantages. So I wanted to go and talk to you a little bit about sort of the impacts around housing and disability. This first slide basically gives you an outline of where I work at, which is the Disability Justice Initiative at the Center for American Progress. Basically, we focus on disability policy utilizing a disability justice framework. We analyze and make suggestions to policymakers about different policies, particularly on the federal level. And we also try to focus on some of the most marginalized communities and believe that developing policy that impacts those most affected by specific policies will help improve policies for all people. It's basically a bottom-up approach. So there's a wide variety of things that are specifically affecting disabled people, but also affecting many other people, even people without disabilities. But the main areas that I'm going to focus on today include things around affordability, accessibility, and availability and accessibility of community supports. One thing that I want you to understand is that disabled people face significant housing barriers, resulting in higher rates of institutionalization and homelessness. We even note that over 40% of those who remain houseless have some type of disability. So that's why it's so important for us to address disability when talking about homelessness. We can't get to a basic point of having no homelessness without addressing disability. So first, let's chat about affordability. Affordability is a significant issue for disabled people. Disabled people are significantly more likely to live below poverty. Disabled people also face significant employment barriers, making them more likely to be unemployed, underemployed, or leaving the job market altogether. Lastly, having a disability is extremely expensive. I know a lot of you have probably heard the term saying poverty is expensive. Disability is expensive. It costs families who have a family member with a disability significantly more to live at the same standard of living as a family without a family member with a disability. We know this as disability tax. Now, looking at this this line graph, you can see basically the poverty rate. The blue line is the poverty rate for non-disabled people. The black line is the line for, switch that. Blue line is disabled people. Black line is non-disabled people. So in 2020, 25.2% of people with disabilities lived in poverty, comparatively to 11.1% of people without disabilities. Now, this trend is not helped by the lack of updates to things like supplemental security insurance and SSDI, policies that were initially intended to keep disabled people out of poverty are actually now keeping disabled people in poverty. With rent continuing to rise, particularly during the pandemic, as well as you heard earlier, issues of utilities rising and even food costs rising, SSI and SSDI payments are barely keeping up and oftentimes not keeping up. Most individuals have to pay almost all of their monthly income on rent alone, leaving them little room to pay for anything else. In many states, the maximum payments for SSDI wouldn't cover the median rate for a one-bedroom household. So you can see that in the one-bedroom, average for one-bedroom apartment in the US is the red line. The purple line is the maximum payment per month for SSI, and the blue line is the average SSDI payment. And as you can see, none of these individuals would be able to afford anything else other than rent. Now, disabled debt. Disabled debt is also a significant issue for disabled people, with 15% of disabled people reporting medical debt versus 7% of non-disabled people. Disabled people are twice as likely to use non-bank financial services, such as payday loans and check cashing. Also, 80% report having no emergency savings to absorb financial shock. This leaves disabled people with less good credit and ability to obtain loans and mortgages. So many of the individuals are relegated to rentals. Now, let's chat about employment. We know that disabled people have higher rates of unemployment and higher rates of being out of the labor force. Now, this graph shows the percentage of people overall in terms of unemployment, non in the labor force, and employed. But in general, in October of 2022, the general unemployment rate for folks still in labor force is 8.2% for disabled people and 3.3% for people without disabilities. So originally, earlier in the year, we were actually at about disabled unemployment rate was about twice as much as non-disabled people. Now it's almost to 3 times as much as non-disabled people. So the disparity between disabled people's unemployment rate and non-disabled people's unemployment has actually increased And unfortunately, disabled people aren't keeping up and aren't able to obtain jobs. We also know that complaints around discrimination based on disability, the percentage has actually increased within the EEOC. You can see in general, the blue line is disability rates, disability cases. The red line is race-based cases. The green line is sex-based cases, and the yellow line, which has stayed pretty linear and flat, is the age line. Another thing that disabled people face is an issue around things just being so much more expensive for disabled people. We call this the disability tax. Disabled people have to pay more for accessible transportation, specific foods, and other services and supports and resources. Families with disabled family members require 28% more income. That's about $17,690 a year more to live at the same standard as similar households without an individual with a disability. So this means that they have less money to be able to afford their housing. One of the biggest barriers that we continue to hear from folks in the community is that accessibility is a huge issue, particularly for individuals with mobility disabilities. We know that in terms of accessibility, less than 5% of housing nationwide is accessible for people with moderate mobility difficulties, and less than 1% of housing is accessible for wheelchair users. So not only is there a general housing crisis, but there's a significantly even higher housing crisis for individuals with mobility difficulties. More often, disabled people are relegated to having to try and obtain housing that is newer and more expensive in more expensive neighborhoods due to the lack of accessibility in older, more affordable neighborhoods. So we looked at one of the housing surveys, and it's the AHS Accessibility Module Survey. And what we found was 6.8 million households reported experiencing physical accessibility issues, with most dealing with issues around being able to enter their own home, which is pretty important to be able to enter your own home safely. And unfortunately, a majority of those individuals were facing difficulties around that. In terms of other significant issues that are included are difficulties using a kitchen, which means that many individuals are either having to get pre-cooked meals or pre-made meals, which are, again, more expensive, causing a disability tax, and then also difficulties using a bathroom. All of those are extremely important daily living activities that you need to be able to do, and individuals are stating that they have significant issues doing these activities. What we also know is that living in an inaccessible house can actually negatively impact the individual's health and general well-being. The availability and accessibility of community services is one of the last areas that I really want to focus on in terms of making sure that we keep in mind. Being able to access those services, things like home and community-based services, accessible transportation, and Section 811 supportive housing are all important in order for an individual to be able to, an individual with a disability, to be able to live within their own communities. Without this, many of them are relegated to institutions or group homes. So what is home and community-based services? Home and community-based services is a wraparound of services that provide individuals with the ability to live within their own communities. This can include things like one-on-one assistance, doing basic living activities like getting dressed, taking their meds, taking a bath, fixing their food, etc. Services can also include things like helping them get from one place to another, helping them go grocery shopping, also helping them get employment and being able to work in the community. Now, unfortunately, we don't fully fund these services right now. About 800,000 Americans remain on wait lists, with lists continuing to get longer. Disabled people are on the wait list for an average of 30 months. Some states it can be years. Some individuals, when their child is born with a disability, providers actually tell them to get on to the wait list right then, so that hopefully they're eligible once they've turned 18. Annual costs for home and community-based services, if you're not getting support from Medicaid, can range anywhere from $8,000 to $30,000 per year, depending on the services needed. Sometimes it can cost over $100,000, depending on the services and the needs. So it's extremely important that we understand that different states receive different amounts of money, depending on where the person lives. Wait lists can be longer in certain states, which means that an individual may be relegated to living in a specific location because of their access to home and community-based services. Another thing, accessible transportation. We all need transportation to be able to go grocery shopping, go to work, and do other daily activities, go to the medical doctors, right? So disabled people are much less likely to live in a household with a vehicle. Disabled people are much more likely to share a ride, walk, or use public transportation. Yet around 30% of rural areas have no access to transit services, and many individuals, I believe it's over 40% of individuals who live in rural locations have some type of disability. So many people lack the access to transportation, and this can be a real factor in people being able to find housing. Lastly, I wanted to talk to you about Section 811, which is a specific housing program through HUD that provides specific public housing funds that go directly to an organization running the housing rather than the tenant, which actually reduces the choice. So Section 811 is an extremely important service because it helps some individuals get out of group home situations. However, the amount of funding depends on, again, what state you live in, and also depending on which organizations are actually participating in the program. And so this can actually significantly reduce their ability to choose where they want to live. Getting Section 811 housing also often requires some type of referral. And you can often be put on wait lists that can last from months to years due to limited funds. So all of these factors can significantly impact an individual's ability to find housing, which can actually result in either homelessness or institutionalization. So thank you.
Thank you, Mia. Mike, thanks for hanging in there. Just really quickly, I read an article that you co-author, Housing is Health, a renewed call for federal investment in affordable housing for families. But what was interesting about that article is that you made a correlation. You pointed to a correlation between the lack of stable housing and health disparities, especially with kids. Let me give you control so that you can move your slides. And if you get a chance, tell us a little bit about it in your presentation. Thank you, Mike. You have control.
Sure, thank you all. All right, let me see if I can, there we go. Okay. Oh, maybe I don't have control. Do I?
Yeah, you should have control. Yeah, you do. You should have control. Go ahead.
Okay. Oh, there we go. Okay. Well, it's good to be here. So yeah, I'm going to move through this very quickly. Yeah, I mean, I think, nationally we have a shortage of about 7 million rental homes that are affordable and available to extremely low-income renter households. And we have a total of about 10 million extremely low-income households that are either homeless or pay unaffordable rental costs that force them into sort of impossible decisions and leave them constantly vulnerable to eviction and homelessness. There are only, another way to look at this is that there's only 36 affordable and available units for every 100 extremely low income renter households. So the point here is that this housing crisis is particularly bad for those at the lowest ends of the income spectrum. Nobody is struggling more than they are. If you look at extremely low income households, you will see again that they bear the burden here. So of those renters across the country that are severely cost burdened, and these are households that are paying over 50% of their income on rent, 72% of those severely burdened households are extremely low income people. Let me go back more. Here's a kind of a spatial way to look at it. And basically what you're seeing here is that in nearly every single state in the country, a renter working full-time and earning less than $15 an hour is simply unable to afford a 2-bedroom apartment. And even in places that you might think are affordable, in many places all over the country, you have to work 80 hours per week at minimum wage to afford a 2-bedroom rental home at fair market rent. So contrary to popular belief, this isn't a Los Angeles, New York, San Francisco problem. This is hitting every place in the country, suburbs, rural areas alike. So sometimes you hear the counter argument of, well, if you can't afford the rent, just work a little bit harder. But 80 hours per week isn't working a little bit harder, right? It's physically impossible. So this isn't about hard work. This is about a systemic failure in our housing system that hits the lowest income people the hardest. Part of the story here is that federal funding has been declining for decades. So what we do at the National Low Income Housing Coalition is we focus on federal policy. There are many reasons, prior speakers have hit on it. I mean, there's many reasons why the housing crisis has gotten so bad. There's failures of the private market, there's failures of public policy. The private market simply isn't producing affordable housing for the lowest income people. There's local policies, there's state policies. There are many local policies that embody restrictive zoning, which increases or constrains supply and increases costs. So, we could go on about the state and local policies, but I thought one perspective that I'd like to offer is more on the federal perspective, because I think that's a story that often gets overlooked. But I think it really is one of a story of federal disinvestment. When people think housing, they think state local, but make no mistake that the present housing crisis is largely attributable to the federal government's retreat. We've well established in this presentation that supply isn't keeping up, rents are far outpacing wages, and yet the federal government spent about 3 times as much on housing programs in the 70s as it does today. Despite significant growth in the number of low-income renters. The federal government significantly cut spending on important housing programs in the 80s, and we've never really recovered since. And as housing becomes less and less affordable, homelessness increases. I think it's important for folks to remember that today's modern phenomenon of mass homelessness, shelters and tent cities and parking lots of RVs, this didn't exist at this scale decades ago, because at that time our country housed almost everybody, including the lowest income people. And in fact, in the late 70s, our country actually had a modest surplus of homes that were affordable and available to the lowest income people. And of course, the big difference between then and now is declining federal investment. So the reason why this is so important is that this isn't just a housing crisis, and this goes to Linda's question earlier, that unstable, unsafe, unaffordable housing spills over into so many other areas of life. When families live in homes they can't afford, we know through rigorous research that kids do worse in school. Test scores decline, behavioral problems increase, graduation rates decline, chronic absenteeism increases, families struggle to find nutritious food, they struggle to climb the income ladder, their health dramatically suffers. We know that health outcomes are worse when people lack access to good housing. There's higher instances of child hospitalizations and developmental delays, asthma, insufficient sleep, mental health challenges, smoking. Actually, young kids that are in unstable housing are 20% more likely to be hospitalized. So when people do have affordable housing, it actually saves us money. So there's a there's a taxpayer argument here that when people have access to good, stable, affordable housing, they have fewer ER visits, they have more preventative care visits, there are lower Medicaid costs. There's one study out of Boston Medical Center that finds that unstable housing is going to cost us $111 billion over the next 10 years in avoidable healthcare costs because people aren't stably housed. So the solutions to this problem, I think, are and I'll hit this very quickly because I have to head to another meeting. But I think one is we have to rally different sectors around this problem. We need to bring in the educators and the healthcare professionals and the civil rights advocates and the anti-hunger advocates and the faith-based community, and say collectively to policymakers that this is a problem that impacts all of us. That whether you're in the education space or the healthcare space, you can't fully accomplish your goals if the people you serve don't have access to good housing. So I think elected officials and policymakers can't just be hearing from housing organizations. They need to hear from leaders across different sectors. And the bigger and the broader the movement, the more effective we will be. And in terms of specifically, what we need Congress to do, again, we certainly need state and local action. But, in our view, that this crisis has gone to such epic proportions that we need action at all three levels of government. And so that means things like, expanding federal resources for rental assistance. It means expanding federal resources to increase the supply of affordable housing. It means federal resources to do eviction prevention. In a lot of cases, it's families are living on very small margins. There's a broken down car or an unreimbursed medical bill, and these quickly send people down the spiral of housing instability, eviction, and even homelessness. And we know that every day people become homeless who not long ago had stable homes, but their lives were disrupted by a crisis. There's some households that need kind of longer, more ongoing support, and that's where things like the housing voucher program would come in. But in a lot of cases, a small amount of money can stabilize people and keep them housed. A lot of times people are getting evicted over a relatively small amount of money. So if we can catch people earlier upstream, it's much cheaper to give somebody $300 per month for the next 6 months to keep them stably housed rather than letting them fall on their face and they end up getting evicted and they're visiting shelters, and that's much more expensive in the long run. So we think that there needs to be a permanent federal program to provide people that short-term assistance for eviction prevention. So those are kind of the three buckets of federal solutions that we think are important to solve this crisis. So with that, I will I'll wrap it up and turn it over.
Thank you, Mike. Chi-Chi, I'm gonna turn to you, and in 2 minutes, can you outline for us some common sense policies that, if implemented today, could eradicate some of the barriers you identified, and how can we all work together to come up with solutions?
Great, thanks, Linda. Can you hear me?
I can hear you just fine.
Okay. So one very common sense solution, easy in concept, but also, well, okay, so the first slide, I'm just going to talk really quickly about one possible solution that is very tricky and complicated, and that's alternative data. So as I said, there's been a lot of focus on consumers who don't have a credit history, and as a result, the push has been to try to get more information into credit reports, namely rent information, utility, and telecom payments. But that is very tricky, and the devil is in the details. As Kevin mentioned earlier, concerns about including rent payment data. We certainly share that. We have seen examples where what's called full file rent reporting data, in other words, reporting negative information as well as positive, literally will make a family homeless because of one negative mark from a missed rent payment. So we have advocated that alternative data be always positive with the consumer's permission, and frankly, that a better way of trying to address credit invisibility is to use the data in bank account transactions via these third-party data aggregators, because that type of information, number one, is always with the consumer's permission, and number two, it provides the data outside of the big three credit bureaus. Going back to one of my first points, which is the credit bureaus are an oligopoly that control this entire market of credit data. And one way to provide some competition and break up that oligopoly is bank account data. So next slide. So the other solution, which is sort of a strong, simple, common sense, conceptually easy solution, but a hard one to implement in terms of getting legislation passed, is to simply ban the use of credit reports and credit scores for non-credit uses, especially in tenant screening, in employment, and in insurance. This can all be done at the state level. We've worked on bills in Massachusetts and California to restrict the use of credit information in tenant screening. There are about a dozen states that restrict the use of employment information, credit information in employment, and the landscape with insurance is sort of complicated. If your organization is interested in legislative advocacy on this, my email address is in the slides. Be happy to hear from you. Thank you.
Thank you, Chi-Chi. Kevin, 2 minutes or less, your policy reforms to eradicate the barriers and how we all can work together to come up with solutions to the crisis.
Sure. I think the best and simplest answer is really just one word: money. That's the problem. That's the answer. There's a lot more complicated, I think, technical desires and ideas that you can come up with to solve for it, but the best way to solve a money problem is through money, and this can be through investment at the local, the state, and the federal level. Rental assistance programs were critical for helping people afford rent and deal with any number of issues that arose from job loss due to the pandemic. But they were a small stopgap, and as they have ended, we've seen the increase in eviction cases, especially in Florida, that come along with the loss of that assistance. So there's some definite, opportunities in providing more broad rental assistance when it's needed. Another option is to provide just direct cash assistance programs. I think we saw one of the biggest factors in reducing eviction in 2021 was the expansion of the child care tax credit. I mean, just giving people money to assist them throughout the year instead of one time at tax season is usually a better idea, and it's kind of regrettable that that policy was not continued. But there's a lot of other ways to assist through indirect forms of assistance, and I think the low-income housing tax credit program, which is one of the biggest generators of affordable housing in the multifamily context, there's all the opportunity to continue to grow that program and renew additional investment because it's a competitive environment. There's a lot of developers and builders out there that want to access the tax credits because, yeah, they're committing to 50 years of affordable housing, but then they can transition it elsewhere, and they get a lot of benefit from that. So expanding those programs can certainly help increase the number of affordable dwellings that are available. and simply making it easier for people to get there. For home ownership, I think there's some other inventive ideas. I think tax credits and indirect subsidies, particularly for older adults, would be really effective. I mean, I think that potentially there's a lot of ways to create a new form of Social Security benefit for older adults who have their homes, to help them, do green initiative and improvements and other things that can help them maintain and keep their homes for a long period of time. The one thing I would hope we would avoid, though, are some of the other kind of technical ideas we've had. The PACE program in particular was one that was a minefield for older adults, and I would really stress that that is not the best model to follow. I think something that is simple and involves direct payment, instead of trying to find a way to shift where the finances are paying for this to things like assessments or property taxes, is the most effective. So just some things and thoughts, but there's a lot of options out there. I think most of them involve some form of financial assistance.
Thank you. Mia, real quickly, 1 minute or less. Can you identify some common sense policy reforms that could eliminate the barriers you identified and ways that we can work together to eradicate the problem?
Linda, you may need to move ahead. Mia cannot stay on.
Okay. All right. Then let's move on to questions. Nelson, do you have any questions?
Yeah, why don't we do just a couple of questions since we've gone over time. Somebody's asking if is there anything going on in the area of rent control? Could there be a law they say that says no, a one unit apartment cannot be $3,000? Is there anything going on in rent control nationally or any part of the country?
Well, in Florida, we had an effort in Orlando. Some community activists banded together and were able to try to get rent control passed in Orange County, which in Florida, for those who are unaware, is incredibly difficult to get. You basically have to get something that is called a rental housing crisis established. There's a technical term that escapes me, but our legislature made it a very high task to meet, and unfortunately, the data that the Orange County Commission relied upon was not the best, and in fact came from an industry expert who all but suggested we don't really have that big of a problem. And there was a huge pushback from apartment associations and realtors in the state to try to prevent rent control and rent stabilization. I mean, again, it's not a doomed failure because it passed. I mean, the measure itself passed. The court system has had other thoughts, but it definitely shows that there is a desire in the electorate for something to be done. And I think that that's an important piece to really talk about. Is there's a lot of community energy out there to solve these problems, and getting people motivated and coordinated together to act is worth a lot, especially at the local level. And I think that's where a lot of the good energy to make change right now can be centered.
Great, thank you. And I think, Kevin, you mentioned the renting by the room. Someone's asking about what about the small home, this thing about the tiny homes, the small homes. Is that any better, or is that leading somewhere else that's going to be problematic?
I think tiny homes are an option, and they're certainly something for some communities to consider, but there always are pitfalls. One, tiny homes are not exactly accessible in many cases for people with disabilities. I think Mia probably could have touched on that pretty in depth, that they're just not really built for people with disabilities. And in other cases, you get into weird zoning restrictions, and you get into some of the same problems that led to the growth of mobile home parks, right? Where do tiny homes get located? Do people buy the land itself? Do they end up renting the land? We've seen a huge growth in private equity companies purchasing mobile home parks and monetizing every piece and parcel of it. So I think a lot of those same problems would filter into tiny home developments. But I think for some communities, they could be a really effective way of addressing things like homelessness for veterans, or homelessness for people who have various mental illness, or I deal with some issues with any kind of collaborative or cohabitation with others in shelter situations. There's a lot of opportunities to use it in, I think, very specific circumstances.
Great, thank you. And then someone's asking, with the increased cost of energy, and maybe people falling behind on their energy bills, perhaps impacting their credit, is anything, what's being seen around that now with the increase of cost of energy? And Chichi, I don't know if you have anything on that related to credit scores and past due energy bills, et cetera.
Sure. So most energy companies, gas and electric utilities, don't report directly to the big three credit bureaus. There are a handful that do. And in fact, there's a huge effort by some of these AstroTurf type nonprofits to try to encourage that. The problem is, as your question sort of posits, this type of full file reporting, month after month, the positive and negative, can have a harmful effect on consumers, especially low and moderate income consumers, when they miss bills, especially when they miss bills during high cost months. I'm based in Boston, and January and February can be pretty nasty for that gas bill. It's going to be worse this year. There's a moratorium on shutoffs during those months if you have a senior or a baby or someone disabled in a house, and a lot of households count on that moratorium to make it through the winter and then catch up in the spring or summer when the costs are lower. If they had full file reporting, they'd have a lot of negative marks on their credit report. Now, negative information from utilities does show up in credit reports, but mostly in the form of collection items, either by the utility or by debt collectors. And that's when the consumer is so late, they've missed so many months that it actually gets sent to collections, which is a far smaller number of consumers than ones that might miss a month or two.
Great, thank you, Chichi. If we didn't get to your question today, please send us an email and we will try to get you answers. And I'll turn it back over to you, Linda. Thank you.
Nelson, before you toss it back to me, can you tell those listeners, those attendees that are online, how they can attend, how they can support us tonight at our in-person awards reception in DC tonight, and put the link in the.
If you're in the DC area, we are having an event, and I've already dropped it into the chat. So we hope to see you tonight. If you are there, have a drink, have a snack for me. I'm not going to be there, but hope you can join us.
Great. And the champagne will be pouring, so have a snack with me, a drink with me as well. Special thanks to our speakers, Gabe, Mia, Mike, Kevin, and Chichi. You are the best. Please join me in sending them the love. It was an honor to be sharing this space with you today, being on the webinar with you today. Again, if you want to support us, you can do so. By joining, signing up for our YouTube channel, subscribing to our YouTube channel. That's a way to support us without a lot of money. Our next webinar will be on December the 6th on the ACP. Please join us then. In the meantime, have a happy holiday that's coming up. And I look forward to welcoming you back on December the 6th. Please enjoy the rest of your day. Thank you.